In March of 2001, a magazine asked one question about the seventh largest company in the United States. It was not a question that required a subpoena or a whistleblower or a forensic accountant. It was a question a school child could ask. How exactly did this company make its money? The reporter had read the annual report, the same annual report that 200 Wall Street analysts, six major banks, five federal regulators, and one of the big five accounting firms had been reading for years. 9 months later, that company filed the largest bankruptcy in American history. The question had been there the entire time. Natural gas in the early 1980s was the most boring business in America. Pipes in the ground, regulated prices set in quarterly hearings, long term supply contracts signed once and left in a drawer for 20 years. Trade volume was predictable because nobody traded it. Then Washington began to open the door. The 1978 Natural Gas Policy Act released prices in stages. The Federal Energy Regulatory Commission's Order 436 in 1985 let buyers and sellers bypass the old monopoly pipelines and strike their own deals. Order 636 in 1992 finished the job. Pipelines became common carriers, and natural gas could be bought and sold hour by hour, like wheat or oil or any other commodity. Suddenly, a whole asset class was in play. Pipelines that had been sleepy, government adjacent infrastructure became arbitrage machines. The companies that owned the pipes understood the regulators and could build a trading desk, and there were not many of them, had a once in a generation opening. One of them was about to take that opening more aggressively than anyone expected. Houston headquartered, 37,000 miles of pipe, a brand new logo drawn by the designer who drew IBM and UPS, a chairman with a PhD in economics, and a private line to the White House. And at the center of that company, from its first day, stood a question they would teach the entire system not to ask. In May of 1985, a Nebraska pipeline operator named InterNorth paid about $2.3 billion for a Houston company called Houston Natural Gas. It was a defensive deal. InterNorth was afraid of being raided, and it paid a 40% premium. Within 12 months, Houston Natural Gas's chairman, a 43-year-old economist named Kenneth Lay, LAI, rhymes with pay, had maneuvered himself into running the combined company. He moved the headquarters from Omaha to Houston and gave the place a new name. The first name they chose was enterone. Forbes ran an editorial joke explaining that enterone is a gastroenterology term for the intestinal tract. The company dropped the last two letters overnight. It was a minor embarrassment. It also foreshadowed the next 15 years, a company obsessed with its image, built on something messier inside. In 1987, Ken Lay hired a McKinsey consultant named Jeffrey Skilling to help Enron imagine a forward market for natural gas. Skilling was a Harvard Baker scholar with a mind for systems. He didn't want to sell pipelines. He wanted to turn gas itself into a tradable asset. Lay hired him full-time in 1990. On January 30th, 1992, the Securities and Exchange Commission granted Enron the right to use mark-to-market accounting. Mark-to-market meant this. If Enron signed a 20-year contract projected to make $200 million, the present value of those future cash flows, say $120 million, could be booked as profit the quarter the contract was signed. It was legal. It was also a machine that required the next quarter to find a bigger contract, to produce bigger accounting profits, to hit the forecast forever. By 1999, Enron had more than 2,200 traders on a single Houston floor, trading electricity, broadband capacity, weather. Skilling's rank and yank system fired the bottom 15% of staff every year. A promotion was worth roughly $1 million. A fall was absolute. The culture selected for performance. It also selected for theater. Internally, Enron's off-balance sheet vehicles were given code names. Some came from Star Wars, GI, Chuko. The most aggressive of them were named after the velociraptors in Jurassic Park: Talon, Timberwolf, Porcupine, Bobcat. The traders thought it was funny. The accountants worked through the night. By August of 2000, Enron's stock hit $90.75, market cap around 70 billion, Fortune 500 rank. Number 7. Fortune had named Enron the most innovative company in America. 6 years running. The corporate slogan in the television campaign was 2 words. Ask why. Nobody was asking. In March of 2001, the asking started. Bethany McLean, Moo Clain, was 30 years old, a Fortune magazine staff writer with a Williams College degree, and 3 years on a Goldman Sachs analyst desk. She had been assigned a short piece on whether the stock was overvalued. She found something strange. Enron reported $100 billion in revenue for 2000. Its cash flow from operations for the first quarter of 2001 was negative. Related party transactions were referenced in the footnotes, but not explained. When McLean called Enron's investor relations team and asked how specific trades worked, she was told the trades were confidential for competitive reasons. She wrote the piece anyway. The lead paragraph contained one question. How exactly does Enron make its money? Jeffrey Skilling, by then promoted to chief executive, called McLean personally. He told her the question was unethical. The following week, Andrew Fastow, Enron's chief financial officer, and 2 other executives flew to Fortune's New York office to try to talk her editors out of running the piece. The article ran on March 5th, 2001. It did not topple the company. The stock stayed above $55 for months. Institutional investors kept buying, but for the first time in 6 years, the question was in print. Every short seller, every skeptical analyst, eventually every employee now had a crack to pry at. 5 months later, and on August 14th, 2001, at 5:30 in the afternoon Houston time, Jeffrey Skilling phoned Ken Lay and resigned. At a press briefing the same evening, Enron cited personal reasons. The stock closed that day at $42.93. Years later in court, Skilling admitted that the falling share price had been a factor in his decision. From that phone call to bankruptcy was 110 days. On the evening of Skilling's resignation, a vice president of corporate development named Sharon Watkins sat down at a computer terminal and began writing a memo to Ken Lay. Watkins' memo was titled Lotsuk's Potential Rational Explanations for Accounting Improprieties. It was the document of someone trying to word it gently without softening the warning. The first sentence read, I'm incredibly nervous that we will implode in a wave of accounting scandals. Watkins had trained at Arthur Andersen. She knew the accounting. She named, by name, the Raptor vehicles, 4 off-balance sheet entities into which Enron had booked hundreds of millions of dollars in hedging profits that she argued were not real hedges, but Enron betting against itself with its own rising stock. She also named an Enron executive who had been pushing back internally. Cliff Baxter complained mightily to Skilling and all who would listen. Lay thanked her. Lay then forwarded the memo to the law firm Vinson and Elkins, the same firm that had drafted much of the paperwork for those Raptor vehicles. Vinson and Elkins spent about 3 weeks investigating itself. Its September conclusion, no further investigation warranted. On August 21st, 2001, 1 week after receiving the Watkins memo, Ken Lay exercised stock options and sold approximately $4 million of Enron stock. On September 26th, in an online chat with Enron's own employees, Lay told them the stock, now around $27, was an incredible bargain. Internal records released later show Enron insiders were selling into that same market. On October 16th, 2001, Enron announced its third quarter earnings, a $618 million loss, a $1.2 billion reduction in shareholders' equity, pinned Zait for the first time in public language on discontinued special purpose entity relationships. The next morning, the Wall Street Journal explained to its readers in plain English what LJM actually was. On October 22nd, the SEC, the Securities and Exchange Commission, opened a formal inquiry. On October 24th, Enron placed Fastow on leave. Inside Arthur Andersen, something else had already begun. Starting around October 10th and continuing until November 9th, Andersen partners and staff in Houston, in Chicago, in Portland, shredded Enron-related documents and deleted Enron-related emails at rates well above the firm's own written retention policy. The shredding stopped only after the SEC formally subpoenaed Anderson on November 8th. On November 9th, an assistant to lead partner David Duncan sent an internal email with the subject line, "Per Dave, no more shredding." On November 8th, Enron restated 4 years of earnings, $613 million of income, erased $628 million in new liabilities, and added a $1.2 billion write-down of shareholders' equity. Final. The financial statements everyone had trusted for 4 years officially ceased to exist. Enron had one last avenue. Its Houston rival Dynegy, 2 miles south on Louisiana Street, ran a smaller but solvent trading business in the same commodities. On November 9th, Dynegy and Enron announced an all-stock acquisition, $9 billion of equity, $13 billion of assumed debt. Dynegy also arranged $1.5 billion of emergency liquidity, backed by Chevron Texaco. The structure was an elegant escape. Dynegy's chief executive, Chuck Watson, later said publicly he had accepted Enron's numbers as given. He had no other choice. The restated numbers were only days old, and days were not enough time to audit a $200 billion trading book. For a moment, for roughly 9 days, it looked as if the bleeding would stop. Enron stock held around $10. Traders on the Houston floor told each other the deal would close. Then, on November 19th, Enron filed its third quarter 10Q. Buried in the filing was the disclosure that another $690 million of debt was coming due almost immediately. Dynegy had not known. The hole was larger than the disclosed hole had been, and larger than the one before that, and there was no reason to believe the next one would be different. On November 28, 2001, the major credit rating agencies downgraded Enron's debt to junk status. Dynegy announced the same afternoon that it was pulling out of the merger. It cited breaches of representations and warranties. Dynegy kept Northern Natural Gas Pipeline, which Enron had quietly pledged as collateral, ending up with one of the last genuinely valuable assets on Enron's books. There had been other attempts. The Vinson and Elkins investigation of the Watkins Memo, the October 16th earnings release, an effort to control the story by declaring the SPE issue finished, the quiet sale of crown jewel pipelines for cash. None of them worked because each of them required the financial statements that preceded them to have been honest. They weren't. Quick word. This episode is sponsored by a private community I run. Inside, I break down more than 100,000 deep dive courses on leadership, finance, and business. The patterns you just watched explained further than any single episode of YouTube can go. If this story made you wonder how an entire industry missed the question for 6 years, the governance and corporate finance tracks inside answer that. Link is in the description below. Now, back to Houston, December 2001. On December 2nd, 2001, Enron filed for Chapter 11 in the United States Bankruptcy Court for the Southern District of New York. $63.4 billion in assets, the largest corporate bankruptcy in the history of the United States at that moment. 3 days later, 4,500 employees at the Houston headquarters were told to clear their desks within 30 minutes. Photographs of cardboard boxes stacked on the sidewalk outside 1400 Smith Street went around the world. The retirement plan, the 401k that Enron employees had been contributing to for years, held roughly $2.1 billion. 2/3 of it had been invested in Enron stock. By January, that stock was trading for 12 cents. Employees lost between $1.3 and $1.5 billion in savings. Shareholders collectively lost $74 billion in market value. On January 25th, 2002, Cliff Baxter, the executive the Watkins Memo had named as the internal dissenter, was found dead in his Mercedes in Sugar Land, Texas, from a self-inflicted gunshot wound. He had been subpoenaed to testify before Congress. Arthur Andersen was indicted in March 2002, convicted in June, and stripped of its license to audit public companies in August. A firm of 28,000 US employees was down to roughly 200 by mid 2003. In May of 2005, the United States Supreme Court unanimously overturned Anderson's conviction. By then, the firm was already dead. Andrew Fastow pleaded guilty in January 2004. 6 years. Jeffrey Skilling and Ken Lay stood trial in Houston from January to May of 2006. Skilling was convicted on 19 of 28 counts, Lay on all 6. Skilling received 24 years and 4 months, later reduced to 14. He walked out of federal custody in February of 2019. Ken Lay never served a day. On July 5th, 2006, vacationing in Aspen, Colorado, he died of a heart attack. Under federal law, his conviction was vacated posthumously. Andrew Fastow, released in 2011, now gives unpaid lectures on corporate ethics at Dartmouth, at Tufts, at Tulane, at the Association of Certified Fraud Examiners, at the United Nations. There are 3 lessons in the Enron story. None of them is the one people usually tell each other. The first is that the fraud was never hidden. Bethany McLean was not an investigator. She was not a short seller. She was a 30-year-old reporter who read the same 10K that 200 Wall Street analysts, 6 investment banks, and 1 Big 5 accounting firm had been reading for years. The evidence was in public documents. What failed at Enron was not disclosure. It was attention. An entire industry of supposed skeptics had been compensated year after year to not ask. The question was there in 1996 and in 1998 and in 2000. Nobody asked because everybody was getting paid. The second is about mark-to-market as a machine. When a company can book the net present value of a 20-year contract as this quarter's profit, it has built a system that requires next quarter to find a bigger contract, and the quarter after that, a bigger one still. After a decade, the real world cannot produce enough real trades to feed the accounting. The company starts booking dubious trades, then trades with itself. Every time a modern scandal lands on an exotic revenue line, community adjusted operating earnings, gross merchandise value, deferred subscription revenue, the same engine is spinning under a different badge. The third is about verification. Arthur Andersen was paid $25 million to audit Enron in 2000. It was also paid $27 million that year to consult for Enron. The people verifying the company were the people the company was paying. The Sarbanes-Oxley Act of 2002 forced auditors to choose between audit fees and consulting fees on the same client and created a federal oversight board for the profession. It was a real reform. It also addressed the instrument, not the orchestra. The culture that decides year after year not to notice, but that is not something a statute can fix. In March of 2001, one magazine had asked one question. 9 months later, $63 billion in bankruptcy, 21,000 jobs gone, $74 billion in shareholder value erased, a retirement plan of 12-cent shares, and one executive dead in a parked Mercedes. The question had been answered. Enron did not die because it was hiding something nobody could see. Enron died because it had been hiding something everybody could see, and the whole system had learned for its own comfort to look somewhere else. If you want more stories like this, subscribe. There are a lot of empires still to get through. The question had been there the entire time. Every empire dies the way it was built. Enron was built on a question nobody wanted to ask.